All right, happy Monday, my degenerates. Welcome back to Trades and Gains, and hello to Massachusetts, Boeing, Montana, Boise, Idaho, or whatever small town you're reporting in or watching this from. It is currently 11:11, so go ahead and make that wish. And it's midday. The caffeine's kicking in, volatility's pretending to take a nap, and Wall Street is doing that thing where, well, everything is bullish until it isn't. And I feel like we put out an episode where it was like everything is bullish until it isn't. So it's kind of funny that this theme is coming back into play. So today's market story, it's pretty simple. Nvidia might be shipping AI nukes to China. Wall Street analysts are bullish at the same time. Never a good sign, by the way. Larry Ellison is backstopping Hollywood like it's a margin call. And while the Fed is quietly panicking about unemployment. And finally, everyone's pretending inflation, geopolitics, and regulation are just, well, vibes instead of news. So, yeah, normal Monday morning, especially before the week of Christmas. Let's go ahead, make like some butt cheeks busted open and break it down. So, first thing we're going to talk about here is Nvidia, China, and the pay to play AI era. Nvidia plans to begin shipping H200 chips to China by mid-February. Now, pause, because this is where the market goes, oh my God, bullish, Nvidia to the moon, Jensen has done it again. But the reality, well, it's way more interesting. What's actually happening here? Well, these are H200 chips, not Blackwell. They're previous gen, but still 6 times more powerful than the H20 junk Nvidia was allowed to sell before. Initial shipments are expected between 40,000 and 80,000 chips, all contingent on Chinese government approval. And this is the kicker. Trump gets a 25% cut on this, like the mob. That's right. We have officially entered the AI tariff economy. You don't ban innovation anymore. You just tax it. Now, why as a trader should you care about this? Well, one, Nvidia unlocks billions in incremental revenue. Even with the 25% haircut, margins are still insane for them. China gets compute power it desperately needs, and domestic Chinese chip makers, congratulations. You basically just got kneecapped in the back alley because you owe a gambling debt. This isn't about national security anymore. This is about monetizing dominance. America basically said, sure, go ahead. You can buy the chips, but just make sure you Venmo us after the transaction. The risk nobody's pricing in, though, Beijing hasn't approved any of these purchases yet. There are talks about forcing Nvidia chips to be bundled with domestic Chinese chips. That means slower adoption, lower efficiency, and political friction. The translation of all this, by the way, it's short-term bullish, it's long-term messy, and it's headline-driven volatility like we've been seeing with the AI market so far. Great for traders, terrible for anyone pretending this is quote-unquote stable. Now, the next thing we're going to talk about is when Wall Street all agrees, because this is way more dangerous than China, the Wall Street consensus. According to Bloomberg, the S&P 500 targets for 2026 are the tightest they've been in nearly a decade. Everyone's clustered between 7,000 on the low end and 8,100 on the high end. That's not a range, that's a group chat. Now, why is this a red flag exactly? Because you would think this is good news, right? Well, when everyone agrees, the upside, it's already priced in. The volatility, it gets suppressed and positioning gets crowded. And the market becomes very, very fragile. You don't need a recession to break this market. You just need an earnings miss, a policy surprise, or inflation refusing to behave. Consensus doesn't protect you, it just exposes you. Now, think about it like this. If every strategist is bullish, who exactly is left to buy? Retail? Think about it. Now, let's talk about the man who's been having a tough year, from Bryce Underwood entering the transfer portal at this point and leaving Michigan after he put up a lot of money to pay that kid $10 million, to Oracle just having a whiplash week last week, the man, the myth, the legend, the man with 4 wives who have all been under 20 years old, younger than him, Larry Ellison, the Oracle founder, part-time Bond villain, and full-time liquidity provider. He just agreed to personally backstop $40.4 billion so Paramount can try again to buy Warner Brothers, because apparently streaming isn't profitable, linear TV is dying, and the solution is, well, more debt. This is the capitalism version of trust me, bro. Now, why do the markets care? Well, Oracle, the stock pops because Ellison is everywhere. Paramount and Warner Brothers spike on financing certainty, and Netflix drops because now there's, well, competition again. But let's go ahead and zoom out and look at this from 30,000 feet. This isn't about movies, it's about who controls distribution in a post-cable world. And the answer is whoever can survive the longest without cash flow. That's not bullish, that's just an endurance race. Where's David Goggins when you need him? Finally, the Fed is blinking, but quietly. Now let's talk about the adults in the room pretending everything's fine right now. Fed Governor Stephen Moran basically said the quiet part out loud. If we don't cut rates more, we risk a recession. The translation here, unemployment, well, it's creeping higher. The labor market is starting to soften like your blue chews wearing off. And the Fed knows it. But here's the problem. Inflation is still above the target. So the Fed is stuck between cutting too fast, inflation resurgence. Holding too long, we get a recession. This is the soft landing limbo. Now, why should you care as a trader? Well, rate cut expectations are fragile. Any hot inflation print wrecks the narrative. Any week's job print accelerates cuts. That's why volatility stays suppressed, but risk explodes on data days. This is a macro sniper market, not a buy and pray market. Finally, let's just go ahead, make like a condom, wrap this up, and bring it home. The big picture, the AI trade, it's not dead. It's politicized at this point. Consensus, bullishness equals complacency, basically. The Fed is behind the curve, not ahead of it, and liquidity is still ruling everything like it should. Now, how to think about positioning. This is not trade advice, but mindset advice. Favor defined risk. Respect the headline risk. Expect fake outs and trade reactions, not narratives right now. This market doesn't need a trend cleanly, or it doesn't need a trend whatsoever, apparently. It lurches. And when everyone's confident, that's when the rug begins to get tested. So if you're wondering why Nvidia rips on China headlines, why the S&P floats despite bad breadth, and why volatility feels dead but dangerous, this is why. Markets aren't pricing outcomes, they're pricing hope. So bring back the galaxy gas because hopium's back on the menu. And guess what? Hope is cheap until it isn't. If you want real-time flow, macro context, and positioning that actually respects risk, that's why we do what we do every day at Investor Central Club. Make sure you like, subscribe, hit the bell notification so you never miss a midday market update from Trades and Gains powered by Investor Central Club. And I'll see you after the next data drop breaks Twitter. Have a great rest of your Monday. Happy holidays to you and your family. Make sure you spend time with them. Have a great day.